This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Now I'm going to look at the question Jolie, which was question 1 from the December 2010 examination. The format of the exam has changed slightly. You'll see that question 1 here is for 32 marks, whereas nowadays the question 1 is for 50 marks. But in essence, this isn't going to make any real difference to us. The 50-mark question is anyway broken up into several sections, as is the 32-mark question. What it might mean is there's slightly more to read, because they have to extract, if you like, 50 marks worth of answer from the scenario that you're given. So what we should always do, and hopefully you know this from previous exams, is to go to the end and see what the requirements are. And here it is, prepare briefing notes. So immediately we have to think, what is the format for briefing notes? Or a memorandum or a letter, whatever, or a report, whatever it's saying. And to some extent they're quite similar. Briefing note will start briefing note. It'll say what it's about. It will be notes for the planning meeting about the audit of Jolie. It will then say, from the, I think I'm supposed to be an audit manager here, to the audit team, and it'll be dated. And it'll have a short introduction, no more than a line, to say, I set out below the points we need to discuss at the forthcoming planning meeting. What are we asked to do? It is to evaluate the business risks. And we have to look very carefully at that, because you could be asked typically to evaluate business risk or audit risks. Here it is business risks. And if you find yourself beginning to discuss anything which is to do with, well, the financial statements might be wrong because, then you are not discussing a business risk. You're discussing an audit risk. Business risks exist quite independently from a set of financial statements. Business risks is messing up the business. Either strategic planning problems, operational difficulties, breaking regulations, whatever it is. It could be competitor action, and so on. It could be the success or failure of a new product you're trying to bring to market. So we're not interested in, at this stage, in saying what the ongoing, if you like, or the knock-on audit risks might be. It doesn't say how many to do, but there's 17 marks for all of this, 17 marks. You're roughly doubling now. We're thinking about, 30-35 minutes for that sort of thing. And for that sort of time, you want to be writing at least 2 pages, don't you? How are you going to get, the 17 marks, really, if you write much less than the 2.5, even 3 pages? Is what we should be looking at to get the right volume. A look here, I think it's usually useful to look through the whole thing. Part B goes on to say, using information provided, identify and explain 5 financial statement risks. And of course we know that once you have got the business risks here, very often the business risks are going to carry on to cause financial statement risks. And that's why I like this question. It gives us very good two-step process almost to identifying financial statement risks. And that's 10 marks. That's a fair bit of time. There's 5 in there. It's obviously going to be 2 marks each. How long are you going to be spending for 2 marks? About 3.5 minutes or something of that sort. It's 3-4 sentences, little paragraph, something of that sort, to adequately explain the financial statement risks. We're not asked to do anything about how we're going to address those, what evidence we might require. We're just asked to explain what those risks are. And then finally, recommend the principal audit procedures, the way, in other words, of collecting evidence, to be performed in respect of the valuation of the JLC brand. And that's pretty short. That's about 10 minutes, something like that. You're not going to be writing a huge amount in 10 minutes, but we do have to explain, I think, what specific audit procedures are doing and why we're doing them. Now, in the exam, you do A and you do B quite separately. You mustn't mix up the parts because it becomes very difficult for markers to mark those properly. But what I'll do, for the sake of efficiency, if you like, is as I go through the question, if I discover anything really, but if I discover a business risk, I'll say, here's the business risk, and look, when you're doing part B, here's the audit risk that this would give rise to, or the potential audit risks. So we cover it really by just going through the question once, rather than having to go through it again. It's much more efficient. I've taken the same approach in our model answer. It is not the way you would do it in the exam. You want A and you want B to make it very easy for the marker to mark. So let's read through this here, see what it tells us, and you have to look right from the start. You have to think about every little detail that the examiner has told you. Why has the examiner bothered with that detail? What am I supposed to do with that detail? Because nearly always there's some way in which you can be expected to respond. So it's a large company operating in the retail industry, where I'm a manager, responsible in Genco, that's the firm of auditors, responsible for the audit of Jolie. And I've recently attended a planning meeting with Mo Pitt, the finance director of the company. This is the first year that your firm has been acting as auditor, and this is always a bit of a red flag. It's not going to give rise to any business risk, because in a way the people working in the company couldn't care less who their auditors are or whether they've changed, but it always gives rise to additional audit risk, because of course we are new to the company with no experience really about maybe what it's doing, or how reliable, or where the difficult areas have been last year, and so on. Acting as auditor for Jolie & Co., you need to gain understanding of the business risk facing your client. Notes of the meeting are as follows. So Jolie sells clothing with a strategy of selling high fashion items onto the JLC brand. New ranges of clothes are introduced to the stores every 8 weeks. The company relies on a team of highly skilled designers to develop new fashion ranges. The designers must be able to anticipate and quickly respond to changes in consumer preferences, and there's a high staff turnover. Now let's just think about the business risk. It sounds a bit as though it's kind of modelled on the Zara, but that doesn't really matter. But we are selling high fashion items. They are introduced every 2 months. New ones are introduced every 2 months. And we're relying on highly skilled designers really to anticipate preferences of consumers. And of course the business risk in here is really to do with the design. Are designers going to manage to keep designing a very large number of new products which are going to be popular with the consumers? And the risk is that we hit a bit of a bad patch. Maybe our design approach goes out of fashion, or maybe we just get it wrong in some way, and we've developed all these new products that go into the shops and they don't sell. And that's a business risk, that your sales are going to go down, really. And there's a high staff turnover in the design team. A high staff turnover in the design team means you have to keep recruiting, and there is a business risk that you will not find enough replacement skilled designers to keep this rate of innovation happening. So again, it's getting at difficulties, risks with design. Now that would be fine for part A. Let's think, if you're doing part B, if there are any knock-on effects from this design problem or potential design problem. And of course the knock-on effects, if I kind of do A over here and kind of B over here, is really inventory. There's a real audit risk that we end up with inventory at year end, maybe recently introduced, and it turns out eventually that it's not going to be selling very well, but we don't necessarily know this until sometime maybe after the end of the year. So there's going to be quite an inventory type of valuation problem here. There must be some of these designs which aren't selling. They can't all be successful, and therefore we're going to have to try and look at these maybe hundreds of designs and say if any of them have to be written down. High staff turnover in the design team. I don't think there is a particular knock-on effect into audit risk. Only very roundabout, but we've really covered it. You know, you recruit bad designers, they're going to produce inventory that doesn't sell. I don't think it adds to that, but it's certainly a kind of additional business risk. Most of the sales are made in store, but there's a very popular catalogue from which customers can place an order online or over the phone. The company has recently upgraded its computer system and improved the website at significant cost. Always potentially bad news whenever you upgrade your computer system, because you may mess it up entirely. And in the UK there'll certainly be a number of banks who've tried to do, in a way, quite mundane stuff with computer systems, and somebody codes the upgrade, the update incorrectly, and the bank's been out of action for weeks with very irate customers. So what's the kind of problem here? And of course there is a problem here that does it work? So most sales are made in store, but there's a popular catalogue from which presumably a lot of customers can place an order online. I think if we look on down a little bit, we might see some information maybe about that. We have the number of phone orders, we have the number of online orders. Almost certainly, if we did a little calculation here, so we're going to have in there about 250 million, something of that sort, and we can kind of work out, I think, what proportion of revenue is coming from online orders. And that would allow us to work out perhaps what percentage of our orders are going to be at risk if the new computer system doesn't work. And we see down here, of course, that there's been a great increase in the dependency on the computer system. Phone orders have gone down, but we've doubled really the number of orders coming through the computer system, and therefore we are, even more dependent on it than we used to be. So the business risk: is this thing going to work here? Will it be recording sales properly? Will it be taking the money properly? Will it be updating inventory properly? There's all sorts of ways it could go wrong. It improved its website, it thinks, but of course the working of the website is really something for the customers to judge, and it may turn out to be a bit clunky. At significant cost. And that's water under the bridge. That's no longer a business risk, really. But here we have a particular problem integrating the website sales directly with the general ledger. It's beginning to merge a little bit into audit risk. So maybe we'll just leave it for business risk, does the thing work? And then we have the new online sales system has allowed overseas sales for the first time. So what happens once you begin to branch overseas here? Well, you could say, are the designs from your home country, how popular are they going to be overseas? It introduces certainly costs and maybe risk of physical loss as you send the stuff overseas, gets lost in transit and so on. And you're going to be presumably having to deal with overseas currency coming in. And the business risk is that there's currency fluctuations. And although you think you're selling for $20 or whatever it is, by the time you get it through the exchange system, it's only going to be worth $14. So I'll put in here maybe exchange. There's maybe a little bit of kind of control as well. How do we control this stuff going abroad and the like? You might be able to, if you needed to, I'm not sure we need to, but when people enter their credit card details, of course it puts the company at a little bit of business risk that a hacker, a virus has got into their system. Customers are putting in their credit card numbers, and those credit card numbers are stolen somewhere, and the company certainly suffers bad publicity and maybe has to compensate its customers. What audit risks come from this? Well, I think if we could go back here and think here, has it successfully integrated sales to the general ledger? Has it taken out the VAT? Has it simply calculated the invoice correctly? Has it added on the delivery costs and so on within that? And how are they actually accounting for overseas income? Because that has to be, translated according to particular rules to deal with foreign currency translation in the financial statements. So here I think we have currency maybe, and there's really integration as potential audit risks. The system for phone ordering has recently been outsourced. So as soon as you outsource anything, there's an immediate problem. How good are our outsource companies going to be? Are they going to be performing correctly? Whatever it is, there's a risk we pick a bad one who doesn't have the right controls and so on. And then there's bad news really. The contract for outsourcing went out to tender, and Jolie awarded the contract to the company offering the least cost. So it kind of builds on this outsource risk for the business. What happens if we outsource to people who aren't very good, who maybe alienate our customers, who maybe don't take orders properly, record them properly, and the like. So here I would say here cost, maybe quality, a risk that we're going to hurt the reputation we have or the trust we have with our customers. And the company providing the service uses an overseas call centre where staff costs are very low. Potential difficulties from overseas call centres because we're at a distance from them. It's more difficult to maybe go and visit them, to see how they operate, to listen in, if you like, actually being there in present physically. The other danger is a kind of almost cultural danger. How will our customers like talking to an overseas call centre? And if the staff costs are low, I mean, what are the language skills like of the people who are being employed there? What might the audit risks be, if any, which knock on from this here? And I think if it goes out to tender, these people are going to be recording our sales, and it'd be interesting to know how well they record them, how consistently they record the sales coming over the phone. It may even, because it's a long way away, it may even give rise to incidents of fraud or manipulation of some sort, because we can't easily go and maybe send in our internal auditors if we had any. Jolie has recently joined the Ethical Trading Initiative, which sounds good. This is a fair trade initiative, which means that any products bearing the JLC brand must have been produced in a manner which is clean and safe for employees and minimizes the environmental impact of the manufacturing process. So that's quite good news. That it's kind of corporate social responsibility, which they are taking part in. A significant advertising campaign promoting their involvement with this initiative has taken place. Is there any business risk from that? And I could argue that there's a kind of potential conflict here, maybe between the ads and the performance. Because the ads are saying we're very moral people, we take this kind of fair trade initiative, we're dealing with our suppliers fairly. But what happens if some television program or investigative journalist goes there and discovers that the factories are unsafe for employees, maybe they're employing child labour or whatever's going on in here? Then, because you've made this big song and dance about how proud you are about the Fair Trade Initiative, and then you're discovered to, not really be doing very much good in that respect, you have this kind of dissonance going on here. And the financial effect, well, first of all, the business effect is that people will take their trade elsewhere. They'll get fed up with you. They'll say you're just a hypocrite, just saying this to get my sales. And they will be very distrustful for you. Of course, the knock-on effect here is probably sales down. And again, the knock-on effect could eventually be, if they really mess it up, but this is very extreme, I think, here going concern. I could just go back. I meant to say something earlier here. They've upgraded, let me just get rid of some of this here. They've upgraded their computer system at considerable cost, or significant cost. And we can think, well, what have they done with this cost, this kind of development cost here? And the audit risk is maybe they have capitalized, which might be okay, but as auditors we need to satisfy ourselves that the tests for capitalizing development expenditure have been met, and maybe it should be written off. I wouldn't have thought they would have capitalized the advertising campaign. That's fairly unusual, but you could put it in as a potential audit risk within that. And then there's the brand name. The JLC brand was purchased a number of years ago. It's recognized that cost is an intangible asset. It's not amortized. The brand represents 12% of the assets recognized. And when they tell you at 12% here of the assets, then it's telling you that this is material. You only have to be 1 to 2% of assets to be material, well above this threshold here. So the financial risk, or not the financial risk, but the audit risk, is keeping this brand name at cost. They haven't amortized it, and we have to certainly review it for impairment. And certainly if the design of the products has fallen off, if people don't like the foreign call center, if it turns out that you've been telling them lies in terms of really what you're doing under the fair trade initiative, then that brand name value is probably going to plummet. The brand is really an ability, a bit like goodwill, to attract extra customers and generate extra profits. The company owns numerous distribution centres, some of which operate close to residential areas. If we look down here, it's also got many shops. I think number of retail outlets is in here somewhere, I think. Here. Yeah, a number of stores. It's a lot of stores. And also a lot of distribution centres. I think the business risk that comes from this is perhaps one of efficient control, knowing exactly what inventory you have, and there's one of fraud. There's once something is very distributed, then you have this extra danger of fraud occurring, of losing track of where inventory has got to. And of course, if you've got many shops, then there is a particular problem maybe with cash, and knowing that the cash has been safely banked. And that is a business risk. It is also, of course, an audit risk. Keeping track of the inventory, goods in transit, making sure that cash is banked, and so on, is both a business risk and an audit risk. Excuse me, I just dropped my pen. And then it says here, a license to operate the distribution centres is issued by the local authority. They have to stick to daytime really for deliveries. They have to stick to certain allowed noise levels and so on there. And the local authority can revoke the license. And in fact, 2 licenses were revoked for a period of 3 months during the year. Now the business risk is obvious. It's going to be disruption. It may take longer for the goods to get to customers. That may lead to customers being a bit fed up, and so on, and could lead to kind of dissatisfaction and loss of goodwill there. And of course, if the license were revoked entirely, then this is going to be a permanent disruption to the business. Insofar as that might knock on to audit risk, what happens if some of your premises, you can't use them anymore? And really what we're talking about here is impairment. If you are not allowed to use a distribution centre anymore, it's worthless to you and will have to be written down. The other thing we should worry about every time a bit of legal kind of problem comes in will be fines and costs. So we have to think, do we need some sort of provision to be set up in the financial statements? So remember on the left here, this is business risk. Impairment is not part of business risk. Impairment is just changing a figure on the statement of financial position. Really, the impairment is an audit risk. Fines and costs are, of course, a business risk. We're going to have to pay them. It's eating into our cash resources and so on there. Disruptions to business risk and so on. Fines and costs are also a potential audit risk because we might not be setting up the right provisions in the financial statements. We could look at this. We can see that the sales through the retail outlets have gone down. I think we've lost about minus 10% there. There's obviously there ought to be a kind of a business thought there. Why has it gone down 10%? It's going to be a need for us maybe to close down some of our retail outlets? Is there going to be a need maybe for us to make some of our staff redundant? This is all kind of business risk. And again, on the other side, when we get on to looking at audit risk, if you're closing down part of your operations, there are financial statement implications for that in respect of assets set aside for sale, in respect of properly valuing those assets. If you're making people redundant and they are entitled to compensation payments, then of course that should be set up as some sort of liability. The finance costs, I think, are trivial in here compared to the operating profit. There's a interest cover of about 10 times. That's not very much, really. We see that overall the revenue's gone down, but the number of outlets has gone up. And again, there's maybe a slight worry about the way the business is being managed, that they may be overextending themselves, that they haven't spotted maybe that we don't need as many stores when in particular the online orders are actually doubling. Now that has given us an awful lot of business risk factors. I think, if you're writing these briefing notes, you ought to be thinking of something like 1.5 to 2 marks per point properly explained. So you might have a kind of a budget. If we're looking at 15 marks, and maybe getting about something towards 10 business risks talked about there, taking a paragraph for each. And I would keep it a paragraph for each. So, I would say new computer system, the business risk is that it doesn't work properly. We lose control of inventory and sales. And if the internet site doesn't work properly, then we may be damaging our relationship with shareholders. And that explains that kind of, perfectly well. When you go down to looking at these distribution centres, you would say, 2 of these have suffered from temporary closure already by the local authorities. This will have caused disruption. If it keeps happening, then the local authorities may withdraw the license entirely. It's going to cause difficulty, and it is going to potentially, we're going to have to write down or get rid of rather, the assets at those centres. Part C asks us to recommend the principal audit procedures to be performed in respect of the valuation of JLC brand name. It's 5 marks. I think we're looking for 5 audit procedures if we could. And we need to explain also, a little bit certainly, why this audit procedure might be, I think, kind of relevant. It doesn't say recommend and explain, it just says recommend, but it's hard to recommend, I think, without, giving some basis of the recommendation. And here's where I think we could go back almost to the very first sentence of the question, if I remember correctly, where it said this is the first year of the audit. And one of the results of that is that we have no file from last year. We don't know how the opening balances were actually established. We, of course, will be able to see last time's financial statements, audited financial statements, where presumably the brand name is sitting there, but we have no idea really how thorough the previous auditors were. So I think the first thing we need to do, before we worry about any sorts of impairment or anything of that sort, is to just satisfy ourselves that the initial brand value, if you like, which hasn't been changed as far as we know, is actually correct. So I think what we need to do is to go back to the purchase documentation from whatever it was 10, 12 years ago and so on, and have a look at that if we can, and certainly have a look at the prior year's financial statements to make sure that the brand name was kind of figuring there at the same value. What there should be in intangible assets is, even if there is no hint or suggestion that the amount, the asset has in fact been impaired, there should be always an impairment review by management. So as I say, this is required under IAS 36 here, irrespective of whether there is any indication of impairment. An entity shall look at any intangible assets with an indefinite useful life and has to look at this annually for impairment. So we should be able to find something which has been produced by management in a way justifying that they're keeping the same value there. If management hasn't done this, then that management hasn't really complied with the accounting standard, and therefore the financial statements do not really comply with haven't been prepared in line with the accounting standard. And if management doesn't do it, it doesn't respond to any request of ours to do it, then we'd be thinking of modifying our opinion. We couldn't say the financial statements show a true and fair view if management hadn't fulfilled these responsibilities. So what we want to do is to ask management to have a look at this impairment review, and then what we need to do is review it. Almost certainly what management will have said in this is that the brand name is still worthwhile, because look at the sales, they're still buoyant, look at the profit, it's still great, which is coming from this brand name. And that's that's primarily what is supporting the value of the brand, that it is still doing good. It is still generating lots of sales for us. If it isn't generating lots of sales for it, it's not worth anything, really. So what we'd be liking to see, I think, is next year's budget, to see whether or not the sales from JLCs seem to be keeping up and buoyant and so on. If they're plummeting down, then the brand isn't doing its stuff. The brand isn't worth what it used to be worth. I think we'd also want to see that the management still has faith in it, still is going to be supporting it. So what's the advertising budget like next year? Because there's a kind of a tendency, if management think the brand has had it, why throw good money after bad? Why keep advertising this brand, which is had it, basically. We would talk, I think, to the marketing and sales director, and ask this director about how the brand is doing, maybe how it is standing up to major competitors and the like. We could ask this person to explain why the sales have gone down, because total sales have gone down, which is maybe not particularly good news if you want to keep the brand value up. What else can we do within this? Well, if the brand was under some sort of threat, if we're worried that the sales are going down because the brand is losing its pulling power, you'd expect that to be discussed at board level, and you'd expect it to be noted in the board minutes. And therefore we'd want to go and look at the board minutes to see there if there was any discussion about the brand, whether it's had its day, whether it's going to be rejuvenated, whatever it's going to be happening within that. We could look at customer comments. They have a website now. Presumably they're going to have some sort of kind of feedback, kind of forum on the website, and the like. We could look at customer letters coming in about complaints and so on. We might even be able to Google and look for press comments, because quite often you get reviews of presumably fashion editors in the suitable magazines who say, this brand is really good, or this brand is very old and a bit tired now, and so on. And these are comments coming in a way from people who know the industry, the fashion industry, much more than most auditors are going to be knowing it. What else could we look at? Well, almost certainly we want a letter of representation, where the directors will say that they believe that the brand is still fairly valued and it has suffered no impairment. And if they're not willing to say that, then we should get really quite worried about that. It says it's not amortized. Is that normal in this industry? Should we be writing it off over a particular period, or is it fair not to amortize it over some sort of estimated life of where the brand is going to give you boosted sales? So I think that's probably, I haven't kept count, but I think it's probably 5 issues or 5 procedures or 5 ways of trying to find evidence that the brand has been properly valued. So everything we need for all parts of this question is given to us in the question. You should embrace large questions with lots of detail, because it means that detail is giving you ammunition with which to answer that question. The hard questions are the short ones, where you're given no help, no clue, nothing to kind of bounce your ideas off, really. And this kind of format we've seen here, very common, where there's like a number of paragraphs as we go down this. And each paragraph has at least one issue, sometimes more than that. But look at each paragraph, and if you haven't found something to raise your interest, if you like, in a paragraph, begin to wonder, have I overlooked it? Think about the details, why they've been given to us, what I could generate as ideas out of that information.